Good morning, everyone. Thank you for joining us this morning for this webinar on understanding the four major option Greeks. Let's continue and let's talk about gamma. Okay, gamma is the second of the four major option Greeks that we're going to discuss this morning. What is it? Gamma measures the rate of change of delta, or the rate of change of directional risk. All right, so delta tells you your directional risk, and we just discussed that. It tells you the directional risk. But gamma tells you how fast that directional risk is changing. Is it going 100 miles an hour? Is it going, the speed limit of, 55 or 65, whatever, depending on where you're at? How fast is your directional risk changing? Gamma of an option is expressed as a percentage, and it reflects the change in delta in response to a 1-point move up or down on the underlying price. So once again, it's that 1-point move kind of stuff. All right, that 1-point move is important to understand how to measure your portfolio based on 1-point move. What's happening to your portfolio if it's something going up 1 point or something's going down 1 point? Where's your directional risk lie? All right, so for example, delta is, if your delta is -100 and your gamma is -25, if you are the primary seller of options, if you're being that options insurance company that we mentioned before, you being the casino, you have the odds on your side, then you're gonna have negative gamma. You're gonna be trading with negative gamma. If you are the buyer of options primarily, you're gonna have positive gamma. Okay, and we'll talk about that. But if you're the seller, you're gonna have that. If you had -100 delta and your gamma was -25, therefore delta will change by 25% for every 1-point move up or down. This is just kind of giving you that a percentage. If you had a -100 delta and -25 gamma, where your rate of change, your directional risk is changing by 25% every 1 point up or down. It's changing by 25% every 1 point up or down. Is that a lot? Is that a small amount? Okay, we teach you those kind of things at the Dorian Way. The gamma, why should you fear it? Okay, why should you fear gamma? When trading short options, gamma risk is most dangerous as you get closer to expiration, especially within 15 days to expiration. Okay, this is why your brokerage firms might require you to hold more monies when you're trading options within 15 days. When you're trading 0-day options or weekly options, they might require you to hold more monies if you have portfolio margin, if you have a bigger account, or if you're trading something like span margin, which is on futures, but you don't need a big account to do. And that's what we teach you as well at the Dorian Way, is how to use span margin, how to trade options on futures. But gamma changes so much faster within 15 days of expiration. Trading weekly options have a great deal of gamma risk because you can't be that far from at the money. You can't be that far from at the money percentage wise. Okay, your delta might say 10 or 15 or 20, and that's, the probabilities are still correct based on those deltas, but the change of that can happen so fast because you can't be that far away from at the money when you're so close to expiration. It's not enough premium to get, if you get too far away. It's not even worth trading. So a small move could cause big price changes, right? So you should fear that. We talk about, and you've probably heard a lot of people talking about 0 DTA, days to expiration trades, trading the SPX. We talk about that a little bit in the Dorian Way, teach people how to do that responsibly, but it's still a lot more risk trading that than gamma risk trading that. It's a lot more gamma risk trading those type of trades, those trades that's a week to expiration or same day expiration or 1-day expiration. It's a lot more gamma risk in that than trading something that's 30 or 60 days out. You can have a move and still it doesn't change your P&L as fast. But it will change your P&L significantly fast when you're within those 15 days if that gamma risk spikes up. All right, next thing, how can you use it? You can use gamma to reduce risk by not putting on positions within 30 days or by taking off positions within 15 days. All right, so the Dorian Way, we teach you, we have some rules, quantitative rules again about managing that gamma risk, managing that directional risk, that speed of it. Okay, so, but if you're doing something because you're trying to get engaged or you're trying to, you make a same day type of bet, we can understand that, but you would need to be able to do that responsibly. You can't allow a bet like on a 0-day trade or a 1-week trade or something that is within 15 days to wreck your account. You have to understand how to manage that.